What if a transaction obeys the wording of a law but defeats its purpose? What if the forbidden word disappears from the document but the forbidden outcome remains? This is the central question behind the Sabbath Pond Test for Islamic banking. Modern Islamic banking was created to help Muslims avoid riba, interest, usury, and unjust guaranteed increase tied to debt. It offers products with Islamic names: Murabaha, Ijarah, Musharakah, Mudarabah, Sukuk, and others. These can be valid and useful when they represent real trade, real leasing, real partnership, and real risk sharing. But there's a harder question. If a product gives money today, takes back more money over time, fixes the financier's return, and transfers most risk to the customer, has the economic reality truly changed? Or has interest only been renamed, divided into contracts, and hidden behind Islamic terminology? This documentary explores that question through a metaphor from the Quran, the people of the Sabbath. The Quran tells of a community by the sea. They were tested with the clear command, "Do not fish on the Sabbath." Then came the temptation. On the day they were forbidden to fish, the fish appeared openly and abundantly. On other days, they did not appear in the same way. Some people looked for a workaround. Instead of openly fishing on the forbidden day, they arranged traps, channels, or ponds so the fish would be caught on the Sabbath, then collected later. On paper, they could say, "We did not fish on Saturday." In reality, they engineered the same prohibited result. The lesson is not about fish. The lesson is about the mindset of trying to defeat a divine command while pretending to respect it. That is why the paper uses the phrase Sabbath Pond Test. It asks whether a financial structure changes the real substance of a transaction, or only changes the route by which the same outcome is reached. Islamic finance is not supposed to be conventional finance with Arabic labels. It is supposed to reflect a different moral architecture. The Quran permits trade and forbids riba. That distinction matters. Profit from real trade is not the same as a guaranteed increase on a loan. Rent from real ownership is not the same as charging money for time while holding the customer responsible for nearly everything. Partnership is not the same as debt. If one party receives a protected return and the other carries the loss. So the issue is not whether banks may earn profit. They may. The issue is how that profit is earned. If the bank buys and sells an asset, does it truly own the asset for a meaningful period? If it leases an asset, does it carry the responsibilities of ownership? If it calls something partnership, does it actually share risk? If the customer defaults, suffers loss, or the asset is damaged, who really bears the burden? These questions bring us from religious terminology into economic substance. In plain language, the paper frames riba in loans as a prefixed extra amount attached to time. Money is advanced and more money is demanded back because time has passed. This is different from lawful profit. A merchant may buy a real item and sell it for more. A landlord may rent a real asset that he owns. An investor may share in profit from a business. These involve trade, ownership, service, effort, or risk. Riba becomes the concern when the creditor's increase is guaranteed, while the borrower carries the pressure. In that structure, wealth grows for one side simply because another side needed time. Classical Islamic sources treated this as a moral and social problem, not merely a technical contract issue. The concern was oppression, exploitation, concentration of wealth, and the devouring of property without justice. That is why classical scholars did not only condemn riba directly, they also warned against legal tricks that recreate riba indirectly. The preprint draws on the Quran, Hadith, and classical economic and juristic sources, including works associated with Hanafi legal reasoning, public finance, and early Islamic economic practice. The message across these sources is consistent. The form of a contract matters, but form is not enough. Intention, outcome, justice, and real economic effect also matter. The Prophet Muhammad, peace be upon him, warned strongly against riba and against arrangements that disguise forbidden outcomes. Classical jurists discussed sale and buyback structures, combined contracts, and conditions that turn lawful forms into tools for unlawful gain. Early Islamic public finance also shows another path. Debt was not treated as a profit engine. People overwhelmed by debt could be helped through zakat. Public funds could support farmers and needy citizens without interest. Waqf institutions could provide social services and even no interest support. The goal was not to squeeze the vulnerable for time-based gain, but to preserve justice and dignity. This classical lens gives us the real test, not can the contract be defended line by line, but what reality does the full arrangement create? The paper then turns to modern Islamic banking products using Mizan Bank as a representative case because its public literature explains common Islamic finance structures. The first is Murabaha, cost plus sale. In a genuine Murabaha, the bank buys an asset, owns it, discloses its cost and markup, and sells it to the customer at a deferred price. This can be lawful as trade, but if Murabaha becomes merely a loan substitute, where the asset is only a paper stop between cash and a fixed repayment schedule, then the Sabbath Pond concern appears. The second is Ijarah, leasing. A real lease means the lessor owns the asset and rents its use, but ownership has consequences. If the bank is truly the owner, it should carry ownership risk and owner responsibilities. If all meaningful risk is pushed to the customer, while the bank only receives a fixed stream, the lease begins to resemble debt. The third is diminishing musharakah, often used in home financing. In principle, this can be closer to Islamic ideals. Bank and customer jointly own a property. The customer pays rent on the bank's share and gradually buys that share over time. But again, the test is substance. Is there real co-ownership from day one? Is rent tied to actual ownership share? Does risk reduce as ownership changes? Or is the structure mainly a mortgage in Islamic clothing? The heart of the paper is a case study, a home finance structure that may look Islamic in its documents, but must be tested in its outcome. Imagine a customer needs financing for a house. In a conventional mortgage, the story is simple. The lender provides money, the customer pays back principal plus interest, and the house secures the debt. In some Islamic structures, the story is divided into parts: sale, lease, promise to purchase, and gradual buyback. Each part may look acceptable by itself, but the question is whether the combined result is genuinely different. If the customer receives the benefit of financing today, pays more over time, carries most risk, and the bank's return is effectively protected, then the structure may have reproduced the same prohibited outcome through several documents. This is where the Sabbath pond metaphor becomes powerful. The people of the Sabbath did not announce rebellion. They arranged steps so that each step could be defended. But the full arrangement still captured the fish on the forbidden day. In finance, the equivalent question is this: Are we using Islamic contracts to create real trade, lease, or partnership? Or are we using them to preserve the economics of interest while avoiding the word interest? The paper's practical test can be expressed through simple questions. During the financing period, who is the real owner in a meaningful sense? If the house is destroyed, who bears the loss? If the asset needs major owner-level maintenance, who is responsible? Is the rent based on real usufruct and the bank's actual share, or is it mainly a disguised money time charge? If the customer pays early, does the bank's return adjust naturally, or does the schedule behave like a fixed interest calculation? Are late payment penalties treated as bank income or restricted in a way that prevents profit from distress? And most importantly, if the deal is explained honestly to an ordinary person, does it sound like we jointly bought a house, you rent my share, and you buy me out gradually? Or does it sound like I gave you money, you return more money, and the house is security? The first may be partnership. The second is dangerously close to the riba pattern. The paper does not stop at criticism. It points to alternatives from Islamic economic thought. Musharakah is partnership. Capital joins an asset or enterprise, profit is shared, and loss follows ownership. The financier is not merely a creditor. The financier becomes exposed to real risk. Mudarabah is an investment trust. One party provides capital, the other provides labor and management. Profit is shared according to agreement. If the business fails without misconduct, the capital provider bears financial loss, while the manager loses time and effort. That is very different from a borrower owing a fixed return regardless of outcome. Qard Hasan is benevolent lending. In Islamic ethics, a loan is not supposed to be a profit machine. It is a tool of help. Zakat can relieve people crushed by debt. Waqf can fund social services and no-interest support. Public funds can help farmers, families, and communities without trapping them in compounding liabilities. These alternatives may be less convenient for banks that want predictable returns, but they are closer to the moral purpose of Islamic finance: justice, mercy, shared risk, and productive economic activity. The conclusion of the paper is not that every Islamic banking product is automatically invalid. The conclusion is more careful and more demanding. Islamic finance must ask deeper questions than paperwork alone can answer. A Sharia board, a bank manager, a regulator, and a customer should all be able to ask, what is really happening here? If it is trade, show real trade. If it is lease, show real ownership and owner risk. If it is partnership, show real sharing of profit and loss. If it is debt, do not hide it behind layers of language. The promise of Islamic finance is not simply to imitate conventional banking more politely. Its promise is to build a financial culture where wealth circulates more fairly, the vulnerable are not exploited, and money is tied to real economic responsibility. The Sabbath Pond Test is a warning and an opportunity. It warns that clever forms cannot fool Allah if the substance remains corrupt, but it also offers a path forward. Return to first principles, rebuild trust through transparency, revive risk sharing, support the indebted, and make Islamic finance not only acceptable in name, but beneficial in reality. Only then can Islamic banking claim to have passed the test, not by avoiding the word riba, but by avoiding its essence. This documentary is based on a scholarly preprint and is intended to encourage reflection, transparency, and informed discussion. It is not a fatwa and should not be used to judge any individual contract without expert review. The core message is simple. Faith is not served by labels alone. It is served by truth, justice, sincerity, and economic arrangements that honor both the letter and the spirit of the Sharia. Please take the full course. Islamic Banking and the Sabbath Pond Test, available on Udemy.